in Treasuries, Jeff?
Yeah, well, it started off wild as a continuation of, as you'd mentioned, the rally across the Treasury curve from last week. But when you start to look at the close for Monday, there really hasn't been much if you look on a close-to-close basis. So if you're the ostrich and cover your head in the sand and just look at the closes, you'd say there's no volatility. But there's been huge swings intraday when you look across the Treasury curve. And specifically in the long bond, you look, it's moved 2.5 points over the last 2 trading days. I'm talking about Wednesday and Thursday. From being up significantly, down significantly, then we came back down significantly, up significantly. It's been a lot of vol, but as you mentioned, just like the stock market, not much has happened since the close on Monday.
Jeff, huge swings then, whether intraday or at the closes. Why? Have we seen the fundamentals change, or is this just crazy changes in sentiment?
Well, it's a huge sentiment shift, and it all started, as you'd mentioned, after the Fed meeting with the tweet from President Trump of instituting the trade sanctions on September 1st against China. And since then, there's just been this massive negative sentiment overhanging the market in general. And so it got priced in very quickly in the Treasury market. We had a 30 basis point move in Treasuries over the course of about 3 days, 3 trading days. And what you've seen here is just everybody try to one-up each other in negative sentiment. And so I think the intraday volatility is reacting to headlines. There's nervousness both sides, where people think that the bond market's oversold, it's overbought during the day. And really right now you're getting a lot of measures that it looks overbought. And so I think right now there's a lot of negative sentiment already priced into the Treasury market. And what you need to see from here is what is going to be the next direction. But in order for yields to continue to move lower, and we've seen a lot of people put out pieces rationalizing negative interest rates, saying the U.S. will go negative, I think in order to get another move downward in yields at this point, you're going to have to deliver really disappointing and negative data here in the U.S. But it's this negative interest rate policy the ECB continues to pursue. You have inverted yield curves across the developed world, and it's causing a lot of nervousness for investors globally right now.
I mean, even as we're speaking, Jeff, we're seeing the 10-year yield tick higher. Actually, now most of the curve is higher, so kind of a reversal. The Dow just rallied almost 100 points in the last few moments. It feels like the bond market is the center of the action. At what point does the bond market not act as a deterrent for stocks and actually lead to the idea that valuations are looking better and that dividend-paying stocks are looking like a better bet?
Well, I mean, it's hard to really – a lot of people like to compare the dividend yield on stocks to the yield that's, say, on the 10-year Treasury. But you have to remember those are different volatility instruments. I mean, the stock market tends to exhibit 5 to 6 times the volatility of the 10-year Treasury. So for people who are looking for safety, it's not necessarily dividend-paying stocks that are going to deliver that smoother profile that necessarily bonds can do. However, you talk about the bond market being the center of activity. It's because we just had the Fed last week where the Fed delivered an interest rate cut, but also Jay Powell came out and said, well, it's a mid-cycle cut. That spooked the bond market. Then President Trump comes out and spooks the bond market the other direction and essentially gets his 50 basis point cut he wanted by taking the 25 from the Fed and the tariff policy driving the curve down that additional 25. And so I think the bond market is saying that, are we going to go into this global recession? Is this really going to be tit-for-tat policy between the U.S. and China? And then further to that, what is the ECB going to do? People expect them to cut rates next month. People now have priced in that the Fed is almost guaranteed to cut rates next month. There's 2.5 rate cuts priced into the market the rest of the year. There's 4 by next year. And so the bond market is really showing fears that we are perhaps getting closer and closer to having a recession, maybe not just in the U.S., but also a global recession due to some of these policies.
Bob, how closely do you watch the yield curve when deciding what is a legitimate valuation for equities?
Well, I think any equity investor has to pay attention to what's going on in bond yields. And of course, we're reading all the, everything about the inverted yield curve and what that means. And it always signals a recession, or often does. So, yeah, you're very concerned because are you missing something in the earnings? But I think there's, all these exogenous factors right now going on. So, yes, I pay attention. And then I look at, there's some question about should you be buying more dividend stocks. I personally am not buying more dividend stocks here because also stocks can go down. And dividend stocks is really about, is the fundamental story good? And if it happens to have a great dividend yield, so be it.